On behalf of Axis Capital, I welcome you all to the Kalyan Jewellers Q4 FY21 and FY21 earnings call. It is an absolute pleasure to host the first earnings call post their listing. We have with us the senior management of the company, represented by Mr. Ramesh Kalyan, who is the Executive Director and the whole-time Director. Mr. Sanjay Raghuraman, CEO, Mr. V. Swaminathan, CFO, Mr. Sanjay Mehrotra, Head Strategy and Corporate Affairs, and Mr. Abraham George, Head Treasury and Investor Relations. So we'll start the conversation with Mr. Ramesh, giving the opening remarks, and then followed by Sanjay sharing the take on the results. So I'll hand it over to Ramesh for the opening remarks. Thanks, and over to you.
Hi, thank you. Good afternoon, everyone. I hope and pray that all of you and your families are safe and secure. I am extremely happy to present to you our results on this maiden earnings call. I would start by thanking all our investors who have showed faith in us. Let me begin by giving a brief overview of Kalyan Jewellers for the benefit of those who were not a part of the IPO roadshow meetings. Kalyan Jewellers was started in the year 1993 in Thrissur, our hometown in Kerala. My father, my brother and myself are in this business since inception. When we started, the jewelry industry was majorly unorganized. We have been pioneers in introducing a lot of fair and transparent trade practices, be it hallmarked gold, rate tag which shows the making charge of the product, carat meters inside the stores, transparency in terms of old gold exchange, etc. The taste and preferences for jewelry in India is different in each micro market. Our brand has been behaving very hyperlocal right since inception. Hyperlocal meaning the product, the communication by way of marketing, the staff at the store, everything will be aligned to the local taste and preferences. This has helped us to be perceived as the son of the soil brand and enabling us to compete with local, regional and unorganized players, thereby capturing a larger market share. Another strength which is unique to Kalyan Jewellers is the My Kalyan network, which we have built over the past many years. My Kalyan is a marketing office which is set up in catchment areas around Kalyan Jewellers showroom. It operates in hub and spoke model with marketing staff and zero inventory. We have 760 plus My Kalyan centers spread across India with over 2,500 field staff. Today, if you look at Kalyan Jewellers, we are not only one of the largest jewelry brand in the country, we are one of the most trusted jeweler, extremely hyperlocal in nature, and we have also created the My Kalyan network, which has enabled us to reach customers at the grassroots level. I would now like to provide some perspective on how financial year 2020-21 has been. It has been a very unprecedented year for all of us. We started the financial year in the midst of COVID lockdown, wherein all our showrooms were closed. During the lockdown, our priority was to ensure safety of our staff, customers, and all stakeholders. We were closely monitoring the situation on the ground and could resume operations without any delay once the local authorities gave permissions, thanks to the decentralized, empowered mid-level management. Q3 was the first fully operational quarter in the financial year 2020-21, wherein all our stores were open. We saw a very healthy growth in revenue. This was primarily because of wedding and wedding-related demand. The growth which we saw in Q3 accelerated further in Q4. We saw a steep shift from the unorganized segment to the organized segment, and the demand for wedding jewelry continued to show good traction. This led to a robust revenue growth of 61% in India and 43% on a console level. On the back of this revenue growth in India and a strong recovery in the Middle East operations, our Q4 PAT grew by 54% year on year. We had a one-time forex gain in Q4 in the last financial year. And if we normalize for the same, our Q4 PAT grew by 71%. We successfully completed our IPO in March and started this financial year by opening 9 new showrooms. We continued to see the same momentum which we saw in Q4 in terms of footfalls and demand. By mid-April, certain states started announcing lockdowns and we saw customers' sentiments also dampening. As we speak, more than 80% of our showrooms are closed. However, we are better equipped, better prepared, and are hopeful that we will come back stronger post this lockdown. Now, let me hand over to our CEO, Sanjay, who will take you through the performance highlights. Once again, thank you for joining us on this call. Stay safe and hope to meet you all soon in person. Over to you, Sanjay.
Thank you, Ramesh. Good afternoon, everybody. Hope and pray all of you and your families are safe and well. I shall start with the highlights of our performance during the quarter ending March 21. Kalyan Jewellers posted a strong performance in Q4 of FY21 with robust revenue growth in India and a strong recovery in our Middle East operations. Total revenue for the quarter came in at rupees 3,057 crores compared to rupees 2,141 crores for the corresponding quarter of the previous year. The growth in India standalone revenues was 61% and at a consolidated level was 43%. Profit after tax for the quarter was rupees 74 crores, which is a 54% growth when compared to the corresponding quarter of the previous year. And to just look back at H2 numbers for the second half of the year, PAT came in at rupees 207 crores, a 72% growth over the corresponding period in the previous year. And in fact, 45% higher than the full year PAT of FY20, a strong performance given the circumstances. The major reasons for the Q4 revenue growth in India were, first, the accelerated shift from the unorganized sector to the organized sector, and second, the resilient wedding and wedding-related demand for jewelry. In Q4 FY21, gold jewelry revenue grew by 70% in standalone India, and studded jewelry revenue grew by 37% in standalone India. This relative outperformance in gold jewelry revenues resulted in a decline in the studded ratio as well as the gross margins in Q4 FY21. For Q4 FY21, the company recorded a profit before tax of 98 crores compared to 67 crores in the corresponding quarter of the previous year, a 47% growth. EBIT for the quarter came in at 173 crores compared to 119 crores in the corresponding quarter of the previous year, a 45% growth. Moving now to H2 numbers, the profit before tax came in at 263 crores when compared to 174 crores in the corresponding H2 of the previous year, a 51% growth. And EBIT for H2 FY21 was 429 crores compared to 306 crores in the corresponding H2 of the previous year, a 40% growth. Moving to numbers for the full year. For the financial year ending March 21, total revenues came in at 8,573 crores against rupees 10,101 crores in the previous year, a 15% decline. The decline in India revenues, however, was only 6.6% for the full year. For the full year ending March 21, the company posted a loss of 6 crores, primarily because of a one-time write-off in the Middle East business of approximately 100 crores, and due to the revenue loss in Q1 FY21 because of the COVID lockdown. The India business, however, posted a full year profit before tax of 187 crores compared to 235 crores in the previous year. I will now share some information about our Middle East business. The Middle East operations contributed 14% to our consolidated revenues during Q4 FY21. We posted a revenue of 425 crores during the quarter versus 502 crores in the corresponding quarter of the previous year. And profit after tax for the quarter ending March 21 was rupees 7 crores versus a loss of rupees 9 crores for the corresponding quarter in the previous year. The revenue degrowth of 15%, which you see, is mainly due to the closing down of 7 outlets during June 2020 in the Middle East. We successfully restructured our Middle East business and have been able to post a profit after tax of rupees 18 crores in H2 FY21 versus a profit after tax of 5 crores in the corresponding period of the previous year, even with only 70% of previous year H2 revenues. Moving now to our e-commerce business, Candere posted a revenue of 22 crores during Q4 FY21 versus 13 crores in the corresponding quarter of the previous year. PAT came in at 53 lakhs versus a loss of 37 lakhs for the corresponding quarter in the previous year. Full year FY21 revenues came in at 82 crores versus 56 crores in the previous year, and the business turned profitable for the first time since our acquisition in 2017, posting a 3 crore PAT versus a 2 crore loss in the previous year. With this, I'm concluding my comments on the financials. Before I open the floor for questions, I would stop by just saying, going forward, we expect performance will be even better because of the operating leverage that will further kick in, as our expansion will be in states where we're already present, which will improve our bottom line and the return profile. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The first question is from the line of Aditya Mathur from Citigroup. Please go ahead.
Yeah, thank you. Good afternoon. Could you share a little bit about the My Kalyan initiative and what's the contribution of this to the business over the past year? And I think a follow-up to that, how should one think of the expansion in this network as you're kind of growing stores over the next couple of years? I think some light on that would be great. And the second question I had was on the jewelry advance purchase scheme. I mean, how relevant is it? What is the current salience? And if you could just talk a little bit about how it's moved over the past 1 year, and could you face a few challenges from given that the enrollments could have been slower same time last year?
Yeah, so first question about My Kalyan. My Kalyan, as I told you, it's a hub and spoke model where we have 6 to 7 My Kalyan centers across or near the proximity of Kalyan Jewellers main showroom. So they meet the customers at the doorstep and they divert them to the main Kalyan Jewellers showroom. That reference sale from My Kalyan, it is almost 20% of our total revenue. And the gold savings scheme enrollment also 35% is contributed through My Kalyan. So the My Kalyan going forward again, when we open more stores, My Kalyan will also be opened near that new stores because every store has a 6 to 7 My Kalyan centers in and around it. Hope I answered the My Kalyan bit.
If I can just ask a couple of things on that, Ramesh, I mean, you said 35% of the gold sales enrollment. So how much would that be in an overall context? So if I were to add both the referrals as well as the gold sales, what would the contribution be last year? And I just also wanted to just clarify on the expansion bit that you spoke about. Could you just share a little bit about how
The last bit I could not hear. I think your line got cut off. The last bit.
Sorry, the last bit was if you could tell us a little bit about the South and non-South split for My Kalyan. I think that will help us sort of understand the plan.
Yeah. So first thing is that 20% is a direct revenue which comes from My Kalyan.
Right.
35% is the scheme enrollment. So usually the scheme revenue is around 23% of the total revenue. So 23% is the total scheme revenue which comes, out of which 35% is from My Kalyan. So if you add that, it will be in the range of 26-27% of the total revenue.
Understood.
Yeah. And regarding the next one is the South, non-South, right?
Yeah.
And it is almost similar. So we have showrooms which has 6 or 7 My Kalyans in and around the main Kalyan jewelers in South India also. The same format is followed outside South as well.
Got it. Could you also talk about the jewelry advance purchase scheme, the original question on that contribution, how much it is? I think you've already spoken about the 23%. Has that changed over the last few years? And do you expect
if you look at Q4, you know that by March, actually the gold savings scheme contribution came down only in the month of March. It was only 12 to 13% because the COVID lockdown of previous year, usually customer remit for 11 months and shop at the end of the 12th month. So when the lockdown started in March last year, our enrollment would have been kind of dampened at that time, and that is why the Q4 scheme revenue is only 12 to 13%. But however, the scheme enrollment in the Q4, we had a growth of 27%.
Understood, Ramesh. Thank you.
Thank you.
Thank you. The next question is from the line of Shirish Pardeshi from Centrum Capital. Please go ahead.
Yeah. Hi, Ramesh. Good afternoon, and thanks for the opportunity to the team. I had 2 questions. Now the IPO has happened. Could you talk something about what is the current debt level, maybe as of 31st March and maybe as of now? And my second question is that could you talk about the consumer behavior? Of course, most of the India is under lockdown, but I'm sure My Kalyan is still operational. So any kind of leads which we have seen in terms of the resilience in the month of April and May. I'm not looking for a number perspective guidance. I'm looking how the operation is working out.
Yeah. So Q4, actually, we saw a very good growth. Now we grew by around 60% in India in terms of revenue. Especially if you look at Jan, Feb in that Q4, our growth was in the range of 35% in India. When we opened up in April, the financial year, actually the momentum was very similar to that we saw in Q4. But of course, after 2 weeks, we started seeing certain states, the lockdown was announced and the customer sentiments also dampened. And if you look at us today, more than 80% of the showrooms are closed. So we saw good momentum in the month of April when we started. Also, we opened 9 new showrooms as well in April. Of course, that is also closed as of today, but we opened 9 new showrooms. That is the consumer, demand pattern, which I would like to highlight in the month of April. So now if you look at, very few stores are open, and even the stores which are open, we have limited working hours, 3 hours, 4 hours a day. So it is very hard for us to give a view of this financial year at this point in time. I think by June end, when the stores start opening, we will be able to give a clean overview or a roadmap for this year.
Thank you, Ramesh. The follow-up which I was asking is that whether this My Kalyan operation is on or that is also standstill now?
No, everything is closed. When the showroom is closed, it is a state lockdown, no? So what happens is that moments completely getting restricted, staff cannot move, etc. So when a state is under lockdown, Kalyan Jewellers is also closed and My Kalyan is also closed.
Okay. And my second question was on debt.
Yeah, I will just hand over it to my CFO.
Yeah.
Yeah,
the consolidated level, our debt is 3,378 crores as of 31st March 21.
And any thoughts how this is going to pan out over next 1.5 years?
As we told earlier that we are not planning to increase the debt levels, and as and when the internal accruals start coming in, progressively the debt will reduce.
Okay. Thank you. I have more questions. I'll come back in the queue.
Thank you. Reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Nihal Jham from Edelweiss. Please go ahead.
Yes, thank you so much and congratulations. So 2 questions from my side. First, on Kalyan, on the My Kalyan network, just to understand it, that ideally, do we open these stores, the My Kalyan network around the main stores in rural areas only, or it is something that we look at opening even in the cities? And do even some of our competitors in southern India have a similar concept, or this is unique to Kalyan Jewellers?
Yeah, so My Kalyan, of course, we have a very good presence in the rural India. The main intention is to bring in the unorganized segment to Kalyan Jewellers. But in the metros also, we have My Kalyan centers around each showroom. For example, we have My Kalyan stores even around in showrooms in Bombay. For example, in Borivali, we have a My Kalyan center in Virar, Vasai, etc. So that is a micro market for us, which pushes customers to the Borivali store.
Sure, that's helpful. And if I recollect right, as a part of our analyst meet, we had also mentioned that we had tried stocking jewelry as a part of the My Kalyan network, which is a pilot which we had abandoned. I just wanted to check that. Is it something that we still plan to continue in the future, or that's an initiative that we don't in the pursuit?
So actually in 2019, we tried out to make My Kalyan also a revenue center by itself and not only driving sales to Kalyan Jewellers. But that strategy did not work properly in 2019, and the My Kalyan actually could not do either of them properly. They could not sell the inventory in My Kalyan, and they could not drive the customer to Kalyan Jewellers as well. So we changed the strategy and came back to our old mode. And again, if you look at now, the sale contribution from My Kalyan is back to normal. So we would like to continue the way what we are doing now, and we don't intend to change any strategy in the immediate short term.
Last question from my side. This is specifically to our core market of Tamil Nadu. Now, one of our national competitors also mentioned that they are trying to increase their presence there. While you do mention that there is a strong shift from unorganized to organized happening, and I'm sure that is benefiting all the players. But just in terms of the competitive intensity among the organized players, specifically in our main market, how is that shaping out? And would you have any sense if you've gained the share among that player set also?
Yeah, so if you look at our growth, we grew more in South India than in non-South. So South India growth was around 70%, and non-South India growth was around 47%. So we had growth in Tamil Nadu in the same range of 70%. Tamil Nadu is already, we have a huge market share in Tamil Nadu. We could again grab more market share in that state. We saw a lot of unorganized shift from unorganized to organized, and we saw a lot of demand for marriage and marriage-related revenue, even in Tamil Nadu.
That's helpful. I'll come back in the queue for further questions.
Sure.
Thank you. Participants, to ask a question, you may press star and 1. The next question is from the line of Deepak Podar from Sapphire Capital. Please go ahead.
Thank you very much, sir. So just wanted to understand you replied to the last participant about the reduction in debt. So any kind of debt reduction plan we have for next 2 years? So any thought process on that?
I'll just hand over it to my CFO.
Yeah. See, our current debt equity ratio at Concall level is 1.12. So over next couple of years, we target to reach it to around 0.75.
0.75 over next 2 years. Hello?
Yeah, 0.75 over the next 3 or 4 years. We intend to bring it down to 0.75. It was earlier at 1.7 before the IPO. Now it is at 1.1. Further, we will bring it down to 0.75. But it is not by reducing our debt. It is by adding our equity. Okay. By way of retainers? Yeah.
Okay, so at the absolute level, our debt level can be at the same range, right?
It is in the same range, yeah.
That's what on maybe next 2 to 3 years.
Yes, we intend to maintain the same range in terms of amount, but the debt equity ratio will be improved over the years because our earnings will also come in.
Understood. And understood this point. And over next 1 to 2 years, any kind of outlook you can share on the revenue side or the margin side, so that would be quite helpful.
Okay, so revenue this financial year, as I told you, we started in April. It was good, but then stores started closing down, and now we are not in a situation to talk about revenue because, first of all, most of the stores are closed down. Second of all, the sentiments of the people has to be kind of respected. But what we saw last year was that post-lockdown, the demand started coming in. It started coming in Q2, then Q3 momentum was better, Q4 it was extremely good. So that is what we expect that this year will also be like. But however, by the end of June, when all the stores start opening, we will be able to give a more better view. And regarding the gross margin which you asked, there are majorly two drivers for increasing our gross margin. One is that increasing our non-South revenue by adding more showrooms in the non-South markets where the margins are usually better than South India. Now, we have 65% of the revenue coming from South, which we wanted to bring it down to 50, meaning 50% of the revenue we want to do from outside South markets by adding showrooms there in the next 5 years. That is our vision, wherein the gross margin will improve automatically because the gross margins are higher outside South India usually. Second thing is that our studded ratio, usually we do a lot of innovative things. Our incentive systems are also aligned to improve our studded ratio. Our campaigns are also aligned to improve our studded ratio. That will also improve our gross margins. However, in Q4, there was a disproportionate increase in the gold revenue. The gold revenue grew by 70% and the studded revenue grew by 37%. That was one disproportion which happened. The second thing is that South India, the revenue grew by 65-70% and non-South India revenue grew by 48%. So these two together, plus the import duty, the customs duty impact, the reduction, actually reduced our gross margin in Q4.
Sir, understood that point. So basically what you are saying is that non-South we are planning to increase 35% to 50% over next 4 to 5 years, right?
Yes.
Okay. So can you highlight what is the difference in the gross margin so that will have some idea?
Yeah, so usually the gross margin outside South India is in the range of 24 to 25%. And in South India it's in the range of 14 to 15%.
14 to 15% in South. So it's a big difference.
Yeah, it's a big difference.
So what is the reason of that?
There are, first of all, outside South India the studded ratio is 30%. In South India it's in the range of 21 to 22%. I am talking about the usual scenario. This quarter has been behaving a bit differently because the gold revenue has been too high. I am talking about a normal SSG growth of 6 to 7% when it comes. I am talking about that kind of quarter or that kind of financial year. Usually, the studded ratio outside South India is 30%, and in South India is in the range of 21 to 22%. That is one major reason for the margins to be better outside South India.
Okay. Understood. Yeah, that's it from my side. Thank you very much.
Thank you. The next question is from the line of Abul Fateh from Baroda Mutual Fund. Please go ahead.
Hey, good afternoon, sir. I just wanted to know, assuming the things normalize by, say, June, so what is the plan? How many stores do you want to open across the country, and the mix between South and non-South? And also the money that you'll be spending on CapEx, including differentiating between working capital and the fixed assets. Thank you.
Yeah. So this financial year, the plan is to open 21 new showrooms, out of which 9 has already been opened in the month of April. 5 were ready to open. That was in Maharashtra and Delhi. Unfortunately, the COVID lockdown in those states were announced and we could not open it. Once the lockdown is lifted, we will assess the market and launch the same. So out of the 21, 9 is done, 5 will be done very shortly, and the rest will be done in the financial year. That is the plan. And when it comes to investment, the usual investment per showroom is 30 crore for inventory and 5 crore for capex. That is the usual standard investment for a showroom, for a 5,000 square feet showroom.
Okay. And out of these 9 that you have opened, what is the mix between South and non-South?
Yeah, out of the 9, 8 were in South India and 1 was in Gujarat.
Okay. And these 5 that are ready to open are in Maharashtra and Delhi?
Yes, 3 in Maharashtra and 2 in Delhi.
Okay. Thank you so much, sir.
Thank you.
Thank you. The next question is from the line of Mustafa Khedwala from Cube Investments. Please go ahead.
Good afternoon, sir. So the metal loan of our company has gone up substantially. While the banks were reluctant to give out metal loans, so have we seen any improvement there? Can you shed some light? That's my first question.
Yeah. So should I answer that or wait for your second question?
No, sir. You can go ahead, sir.
Yeah, 1 second.
Yes, Mustafa, we have increased our gold metal loan substantially from last year to this year. Unlike in the past, there is no restriction as of now from the banks in ramping up our metal loan. So our target is to further improve it. We have scope to increase it by another 800 to 1,000 crores.
Oh, interesting. And sir, you've also mentioned that there has been a large shift from the unorganized to the organized segment. So sir, can you shed some light as to how much of the market in South especially is organized versus unorganized, and how much market share have we actually gained?
Yeah, so if you look at the new customer footfalls, it has been in the range of 50% plus, which means that the market share in the markets have improved. That has been constant in South as well as non-South.
Mm-hmm. Okay, sir. Thank you.
Thank you.
Thank you.
The next question is from the line of Deepak Mittal from Edelweiss. Please go ahead.
Yeah. Hi, Ramesh. How are you?
Hi. How are you?
Good. So, congratulations again for the IPO and for the first earnings call. My question is with respect to this gross margin. There has been a very significant decline if you look at the gross margin as a percentage of revenues.
Yeah.
So last quarter, it was 21% plus, and this year, last quarter is less than 15%. So again, just trying to understand what really happened. Is it that we took certain inventory risk, but the pricing worked out?
Last Q4, there were one-timers which has made it 21%. A usual gross margin is in the range of 17%. That's 17 versus 14.6 to be precise in India. That gap has been majorly because of, or only because of, 3 factors. One, the South Indian revenue grew more than non-South revenue, where I told you that South India gross margins are lesser than non-South markets. That is a bit of a disproportion. The second is that the growth in plain gold jewelry was at 70% and the studded jewelry growth was at 37%. That was the second disproportion. The third one is that even in the plain gold, we saw the unorganized segment asking for the staple low margin products, which was in high demand. Because usually the unorganized segment first shop those kind of products wherein they would have saw that with their neighbor or their friend and they come for the same kind of product, which because Kalyan Jewellers is a hyper-local brand and we stock the local inventory, we could cater them. However, the gross margins in those staple products will be lower than the plain gold jewelry which we sell otherwise. So these three things plus the customs duty cut actually brought down from that 17%, the normal 17% to 14.5%, 14.6%.
And any guidance you would like to give on gross margins, as we model this business for next 2-3 years?
Yeah, so I would, because we have seen a huge momentum in revenue growth. If this is the kind of growth which is going to be there in the future, which we don't know, whether this momentum of 60% is going to continue or not, if that is the case, the gross margins will be in this range or a bit better than this range because you see a lot of plain gold coming in. But if you look at a normal year where your studded ratio is in the range of 23-24%, the south non-south mix is 35-65, it should be in the range of 17%. That is a normal kind of gross margin which we should have done. But once it is actually going in a disproportion like this, your gross margins will again get in this level 14.5 to 15%. But two things which I have to highlight there is that one, the customer who is coming now on a staple product, the customer is going to stay with us, and this same customer is going to give us a higher margin revenue in the future because the stickiness in our industry is extremely high. There is very rare chance that a customer goes out from a brand, especially in our sector. The second thing is that the 5-year vision which I told, wherein more number of stores outside South India, where the margins are higher, will take your gross margins on a higher note. So these are the two things which I wanted to highlight. But if you look at the gross profit on a volume, it was very high in Q4. So that's what I wanted to just highlight.
And what is the, thank you so much for that. What is the sort of current situation of 107 stores? How many stores are currently operating? I'm assuming that just what has been the kind of traction in the last 2 months, April, like after the results, April and May, in these 2 months, given that there's been a lockdown situation on and off in many states in the country?
Yeah, Sanjay, you want to take?
Hi, Sanjay here. So as we speak now, about 75 to 80% of our outlets are closed. I think it's closer to 80% today as we speak, and that's been the trend, over the last 45 days. Having said that, gradually we are seeing relaxations coming through in various states as things are getting better to some extent, relatively speaking. And it's difficult to put out a number saying how soon or a date how soon we can get back to normal. Sure. But we hope by June we can have the ulta of what I'm saying, which is 75% shops operational as against 75% closed now.
Yeah. Okay. And is the Middle East stores, the 30 stores in Middle East, are they operational right now, or there are issues with respect to lockdown and COVID?
Yeah, for Middle East, all the showrooms are open. Middle East, there is no lockdown. However, from the second week of April, where the air connectivity, etc., was stopped from Middle East to India and from India to Middle East, the revenue is a bit softened there. Akshaya Tritiya was good, but otherwise the momentum has been a bit softened when you compare with your Q4 momentum.
Sure. I'll come back in the queue. Thank you so much.
Thank you. Participants, to ask a question, you may press star and 1. The next question is from the line of Amnish Agarwal from Prabhudas Lilladher. Please go ahead.
Yeah, I sir, a couple of questions. One being that what is the proportion of gold which is taken on gold metal loan and how much is funded from our debt? And secondly, we are giving your guidance of reduction in...
Sorry to interrupt
Yeah.
you. Yeah. Ladies and gentlemen, the line for the management has got disconnected. Please hold while we reconnect them. Thank you. Ladies and gentlemen, thank you for patiently waiting. The line for the management is reconnected. Thank you, and over to you, sir.
Sorry, we are back.
Mr. Agarwal, please repeat your question.
Yeah. So my question was that what is in absolute amount the funding now which is the company is taking from gold metal loan, and how much of the gold buying is funded through debt? And when we are giving the guidance of say 0.75x debt to equity in the next 3-4 years, and currently it is 1.1. In absolute amount, what sort of a debt reduction you are looking for in the next 3-4 years? And my second question is that what is the quantum of inventory gains due to, you can say, increase in the gold prices in the first half of last year? Because I presume that Kalyan was having most of the gold which was owned by them, which was taken by taking debt from the, you can say, banks. So these are the two questions from my side.
Yeah, hi, this is Abraham here. So on your first question on the total debt, so we have total debt of 3,378 crores, out of which 1,418 crores is by way of gold metal loan, and the remaining is largely OCC. Just about 50 to 60 crores is term loan, but the remaining entire portion is OCC. The second question was on the debt reduction. The point, yeah, I just want to clarify it here. Our intention is not to reduce the absolute amount of debt. The absolute amount of debt will remain more or less the same at 3,300 levels. But what we were trying to say is that with more internal accruals coming in, the debt equity ratio will gradually come down, and our target is to take it to something like 0.75. That was the point that we were trying to make. The third question, I think from your side, was on the metal profit. Yes, we did have some metal profits in the first half, and that was in Q1, which was closer to 40 crores.
Okay. So beyond the 40 crores, there is no other quantum of gains from the, you can say, inventories?
No, not after that.
Okay. And sir, now as your balance sheet has improved, so why do we want to keep that at, say, 2,300 crore levels? Is the cost of our debt lower than taking the gold metal loan?
No. In fact, the cost of gold, your question is not clear. If you could just clarify the question.
Yeah. You see, gold metal loan we plan to increase, but you are saying that our debt will remain more or less at the same level. So my question is that is our cost of taking debt lower than if we take gold under gold metal loan? Because the gold metal loan is cheaper, then we better take more gold metal loan and reduce debt further.
No, I got your question. So the 3,300 crore debt is including the gold metal loan of 1,400, and our cost of taking gold metal loan is actually cheaper than our OCC. Gold metal loan cost typically is in the region of 3.75 to 4% compared to the OCC cost, which is in the region of 10.5 to 11%. And our target is to increase our gold metal loan component from the existing 1,400 gradually up. That's the target. And this will reduce our overall interest cost also.
Okay. But the absolute debt amount you are saying will not come down?
Yeah, the total of gold metal loan plus the OCC will not come down.
Okay, understood. Thanks.
Thank you. Participants, to ask a question, you may press star and 1. The next question is from the line of Shirish Pardeshi from Centrum Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity and the follow-up which I wanted to ask on the international business. So we have closed 7 showrooms as per the slide which you have put it. Is there any further room for reduction? And the follow-up what I have is that what is the plan? Like you gave the India plan opening up the showroom, if you could share in the Middle East. And the second question which I have on the profitability. Is this a steady state profitability one can build in our model, or is there any further legs to improvement further?
So in terms of the closure of Middle East, 7 showrooms which we did, that was predominantly in the tourist areas and the blue-collar workers who were residing in those markets, wherein we did not see any visibility for the next 2-3 years because of the COVID situation. That is why we closed those showrooms. So we had 30 showrooms. Now we have 30 showrooms. It was 37 in the previous financial year. If you look at the Q4, we had 85% of the revenue of the previous year, even after closing 18% of our showrooms. That is the Middle East status as of Q4. However, there was a lot of consolidation which has happened in the Middle East market, wherein the organized players are actually taking the market share, which helped us to improve our gross margins, which was usually in the range of 13 to 14%, to a 16 to 17%, which is today. So there has been an improvement in gross margin as a percentage, and the revenue is 85%, even after closing down 18% of our showrooms.
I got that, Ramesh. What I wanted to understand, if you can share the store opening plan for next 2-3 years in the Middle East market. And the question which I was asking, is this a steady state margin which can build in?
Yeah, it is a steady state margin as of now because the margins have improved in that market, and the small players are vacating. Many people have vacated, so this margin is going to stay for Middle East. And in terms of expansion in Middle East, we will be opportunistic in that market over the next 12 to 24 months and then decide on the expansion. The India IPO which has been done will be fully for Indian expansion, and Middle East expansion will be only with the profits earned there.
Okay. Thank you, Ramesh, and all the best to you and the team.
Thank you. Thank you.
Thank you. The next question is from the line of Manoj Menon from ICICI Securities. Please go ahead.
Hi, team. Good afternoon. Just a couple of questions from my side. One, just wanted some perspectives from you on, hallmarking, which is now expected to be implemented from 15th of June. Just the reason I'm asking because some of the statistics, looks too good to be true because, maybe there is like 400,000 jewelers in India, less than 10%, are BAS registered. So just trying to understand 2 things, from you. One, is it realistic to expect, the implementation of hallmarking in such a short span, and that too in times like this? Point number 2, how do you look at it as from a realistic benefits, assuming it actually gets implemented?
Yeah, Manoj. Hi, Ramesh here.
Hi, sir.
So, hallmarking, first of all, whether it is realistic or not, but it is going to help us big time for organized segment because now people shopping with the unorganized segment, I would not blame everybody, but certain unorganized players do sell inferior quality, which customers are unaware. Customers think that they are selling cheaper and they go to them. That is going to get stopped now because they will have to sell pure gold. Again, this will drive customers from the unorganized segment to organized players like Kalyan Jewellers. So it is going to help us big time. And in terms of implementation, June 15th, we don't know whether they are going to implement because COVID times we really don't know. But they have been pushing it for 1 or 2 times before. So I think implementation is not going to be extremely tough. Hallmarking centers are there everywhere now. They can do it. And I think it is a need of we should make the industry pure, because it is going to help the industry totally. Like Dubai, for example, Dubai, anybody can buy and they are sure of the purity. So purity should be assured, which is actually giving a positive momentum for the whole industry. So I don't know whether June 15th, but it should come very shortly. So.
Understood. In fact, I was surprised at the postponement by only 15 days. I mean, it was supposed to be from 1st of June. Anyway, so understood, sir. Actually, that's fairly straightforward. The second thing, on your performance, it was very pleasing to actually see the significant acceleration, in the southern India markets. 70% growth is like stunning. But at the same time, just trying to understand, is it more to do with, maybe there are two tailwinds I could see. One, the weddings, etc., probably happened, as planned, and so there was probably a market tailwind there. Point number two, I'm sure there have been some activities which you would have done as well. So just trying to understand the sustainability of the South outperformance angle. It's not about the numbers as such, but that depends on gold price. There are a lot of other factors which may come in. But is it fair to assume that, would you be able to, let's say, on a same-store level basis, I'm not even counting the number of new stores, etc., to ensure that South continues to outperform? Or how do I think about this aspect?
Yeah, so one reason why South is outperforming outside South India for Kalyan Jewellers is that in South India we are there in almost all Tier 1, Tier 2, Tier 3 cities here, wherein people who are residing in a metro in South, even if they have migrated to their hometown, we are able to actually cater them because our stores are there in the rural villages as well, meaning the Tier 2, Tier 3 cities as well. But outside South India, we are there only in Tier 1, Tier 2 cities, wherein if a customer is in Bombay now residing at Kolhapur, for example, due to COVID, we will not be able to cater them. So that is the major reason what we feel that the revenue growth is more in South than in non-South.
Got it. Is there anything on the competitive activity or intensity part in South which would have changed, or anything which would have done better, other than the macro part here?
No, so we are always a hyper-local player. So when the shift happened from the unorganized segment to the organized segment, we would have benefited is what we feel, and we could cater them well because we already have the staple products. And the second thing is that, as I told you, people who are residing in a metro, when they come to a Tier 3, Tier 4 city, as of now, because they work from home, we have stores there to cater them. These are the two major highlights where the South revenue actually grew, is what we feel.
Understood. And lastly, on the customs duty reduction impact, would you be able to give some sort of a color on, let's say, what is this one-off? Because the reason I'm asking, because this is actually sitting in the margins, and obviously this is a one-off. There's been a few questions asked earlier about, why the gross margin has declined, etc. Just trying to understand from a forecasting point of view, how much should I take as the one-off, and so that we will have a probably better handle on 22 and 23 estimation.
Manoj, hi, Abraham here. I'm not too sure if I can give you an exact amount here on the impact of customs duty cut. But the reality is about 2.5% duty cut was there. And given our current inventory turn, this should take about 5 months for the impact to be washed out of which 2 months have been consumed in the last quarter. And we will need 3 full months of operations to kind of completely take the impact out. Why I wouldn't be able to give an exact amount, it's slightly comparatively sensitive, this data, the calculations.
No, understood. So because I remember conversation with Titan as well, so we don't really have a number as such from Titan as well, also on this.
I think broadly you can do the back of the envelope calculation. This is like a 2.5% knockdown on the gold inventory.
Understood. Thanks, guys. All the best. Stay safe.
Thank you.
Thank you. The next question is from the line of Vinod Malviya from Union Mutual Fund. Please go ahead.
Yeah, hi. Hi, Manu. Congratulations for a good set of numbers. My question was on gold on loan. So the total gold on loan what you have, how much of is it secured through, to collateral or any form of like collateral, either bank guarantees or letter of credit? and how much is the unsecured component?
Hello?
Hello?
Yeah. So what's your question? Can you repeat, please?
So I wanted to understand that the gold on loan what you have, that is backed through, how much of it is backed through letter of credit or bank guarantees, and how much is unsecured? Or is it like 100% backed through?
See, the gold loan is part of our consortium banking arrangement. There is no separate collateral, etc. It's part of the overall working capital limits, which has been carved out. It is fungible between GML and CC limits.
Okay. Okay, and so when you say that 4% is basically the cost of gold on loan, that includes the collateral which has also been taken on for the gold on loan?
No, there is no separate add-on towards collateral cost. Collateral is part of the consortium banking arrangement, nothing tied up to specific gold metal loans. So there is no additional cost to be added for gold metal loan.
Okay. Okay, yeah, that's all from my side. Thank you.
Thank you. The next question is from the line of Abneesh Roy from Edelweiss. Please go ahead.
Sir, congrats. Just one question. In the presentation, you have spoken on My Kalyan and Hyperlocal multiple times. So, wanted to understand 5 years down the line, how much percentage of revenue you expect from this. And second is, in consumption, we see any good practice being quickly followed by rest of the players. So, what part of the industry also does this kind of a practice?
So My Kalyan is a unique marketing tool which only Kalyan Jewellers has till today. And if you ask the revenue growth from the My Kalyan, we would actually, it has been growing about 0.5%, 1%. So we would be in the range of what, now it is in the range of 20%, which will actually go to a range of what, 22 to 23% over the next couple of years is what we feel.
What is the entry barrier here? Why rest of the players are not doing?
No, so actually this My Kalyan we have started what 10 to 12 years before, wherein initially for the first 3 or 4 years you will have to be very patient, wherein you will do tie-ups with marriage halls, you will do tie-up with all the marriage and marriage-related vendors like astrologers, caterers, etc., event managers, wherein you will not see any revenue coming in for the first 2 or 3 years, wherein you will be building your team, building your marketing team, building your relationships, etc. It is a long-term call, which many players did not take at that time. Many players tried, but on a short term they came out. So it is a long-term game where you will need a couple of years to establish a My Kalyan infrastructure is what we feel. Now it is paying off for us because of our patience.
And obviously team's remuneration will be linked to both fixed and variable to sales, right?
Yeah, so it is we take an office, so office has a rent and we employ staff. Staff has to be paid salary and we pay a good variable as well for the revenue which they bring in. And all are under our payrolls. It is not a kind of outsourced mechanism. Okay. We have more than 2,800 staff working in My Kalyan.
And the expansion will be linked to the number of physical stores, right? So yes. Now it's a stable base.
Yes, yes. It will link to the physical store expansion because usually 6 to 7 My Kalyan centers are usually, a typical model is to open 6 to 7 My Kalyan centers across the main Kalyan Jewellers store, around the main Kalyan Jewellers store.
Oh, okay, that's all for me. Thanks, sir.
Thank you.
Thank you. The next question is from the line of Abul Fateh from Baroda Mutual Fund. Please go ahead.
Hello. Yes, sir. I just wanted to know how should we look at your tax rate in the next 1 or 2 years? Because how do we model it?
Hello?
Yeah.
Yeah, your question on the tax rate, even currently it is 26%. So, by and large, it will be the effective prevailing rate of taxation, which is 25.17.
Okay. So Oh, thank you.
Thank you. As there are no further questions, I would now like to hand the conference over to the management for closing comments.
Yeah, thank you, Ramesh here. So thank you all for joining us on the call. Please stay safe. We will again catch up later in the next quarter. Thank you very much. Thank you.
Thank you.